Welcome back to Call to the Bullpen, where business leaders get insights they need to make the right calls. I'm Jason Carvalho.
And I'm Clint Overton.
And I'm Ted Stann.
Today, we're talking about a challenge I know firsthand because I'm living it every day. As an emerging fund manager building Humaness.vc, I'm operating in one of the most demanding environments first-time GPs have ever faced. Fundraising has been under real pressure. In 2024, private asset fundraising came in around 1.1 trillion globally, down 24% year over year and almost 40% below the 2021 peak. LP scrutiny has only intensified. Last year, 43% of emerging fund managers met with more than 150 prospective LPs, up from 27% the year before. And almost half needed 5 or more meetings just to secure a single commitment. The bar hasn't just moved, it's gotten higher. LPs expect you to look and operate like an established platform from day one. And here's the irony. Despite all the headwinds, LPs still see opportunity. 38% expect the number of new emerging fund managers to increase over the next 3 to 5 years. And the data backs the optimism. Emerging PE managers hit top quartile performance 34% of the time, compared to 25% for all funds, with average returns about 250 basis points higher. When I started Humaness.vc, I knew the thesis was strong: national security, space infrastructure, industrial reliance. The deals were there, the network was there, but raising and operating a first-time institutional fund is like building a plane while flying it. So, gents, I gave a little background for our listeners. I know Clint is, what's going on here? Where are we going with this? For our listeners, I always like to give a little data context. If you're not in the space of emerging fund, if you're not a VC, if you're not in the PE world, it's a totally different dynamic. And we want all of our listeners to feel comfortable as they join us. This might be the first time you heard Call to the Bullpen. This might be your first episode. So you might be wondering, what the heck are these folks talking about? Today, we are going to get into it. We're going to talk about what are we going to call it? OAAS, which I won't give away right away. But Clint, we were talking before this session, and I think you said, "Hey, Jason, why don't you get into your journey and let's start from there, right?"
Yeah, I thought it would be very helpful. I mean, and to your point on how to kind of get any of these conversations going, I think context is king. It's super important just to understand what problems are existing out there for folks that are out in the ecosystem, and then where we spend a lot of our energy and time in these conversations is identifying problems and talking about how you solve them. So I think giving that context is very helpful. And you're talking a little bit about what's happening in the venture space, very similar in terms of what we're hearing on the private equity side. So lots of folks out there, money on the sideline, trying to put it to work. A lot of entrepreneurs out there. Sometimes some of them are former CEOs, some of them are former private equity operating partners, really looking to put cash to work, thinking through kind of new and different ways that they want to put a spin on what their experience has been in the past, for instance, in private equity. Kind of new mindset. You're certainly saying what I would say is kind of an emerging view in the private equity space of buy and hold. So less about kind of grip and rip, so to speak. And, I think there's a lot of folks who have not been happy with their experiences with traditional private equity. There's a lot of kind of reputation out there that private equity funds are trying to overcome. And there's a lot of new players out in the field who are trying to kind of attack where they see opportunity. And then you also have this really large dearth of baby boomer businesses that are coming up for sale that private equity is really going after, with what I would say is a lot of intentionality right now too. So I think all the background and context you provided is super helpful for kind of what we're going to talk about today. And I think, what I'd love to hear maybe a little bit more from you is where is it that somebody who is raising a VC fund or maybe raising a PE fund, somebody who's maybe even in kind of that independent sponsor seat, who doesn't have a fund yet, but does have groups of investors that they're bringing capital into to play in terms of business acquisition. Where are the two places that you're spending the most of your energy? I have an idea of what I think that is, and then what creates the most stress for you, in that process.
Yeah, it's a really interesting question because every year that answer changes. When I started this journey, it was you're on year 2 right now. So for background for the audience, I've been fortunate to be an angel investor, which is where I started to get my understanding of the landscape. I had my own systems internally that we've been leveraging. When you're looking to when you're looking to get into the market, you are looking and talking to LPs that want to see institutional grade processes before they commit. And so the pressure is not only you have to get out there and you have to, it takes longer to close deals. Investor diligence is usually extremely deep on ops and compliance and reporting. And over the last few years, there's been a shift. Right? 2021, low interest rates, let's go, go, go. Large firms like TPG and others were acquiring companies at a rate we'd never ever seen before. The largest VC firms were deploying the largest amounts that we've ever seen before. And then 2022, 2023 hit. And all of a sudden, when you're having a conversation as an emerging fund manager trying to pull and acquire money, the question of how are you operating comes up. And I'm not saying that it did not come up previous to this 5 years ago, but it was not a question that I think LPs were really digging deeper into. Because during that time, from my perspective, again, 2017 all the way up to 2021, there was a massive amount of opportunity in the market. And what everyone was trying to do is they were trying to place their money in a place that was going to make them the best, the highest amount of return. And so what usually happens in that case, from my perspective, is due diligence on not only who you're investing in, maybe if you're talking about an investor into a startup, but also now an LP going into a fund, you're going to deploy your capital with a smaller checklist of due diligence. So again, to summarize, now we're seeing LPs look and say, okay, love the opportunity, but how are you going to increase the probability that you can get the ROI within a time frame that is manageable? And just for context, for those that don't understand what an emerging fund manager's journey is like, it's a 10-year journey. And what you're promising to your LPs is after 10 years, someone will have made some money, basically, right? So let's just say you're doing 10 bets and the first 2 years of a fund is you're trying to raise it. In the current environment, it's like you're seeing emerging fund managers do 3 to 4 years, right? Basically building the network, raising the capital. Ideally, by the end of year 3, they've closed their first fund and they have 12 months to deploy that. And then by year 4, end of 4.5, 5, they're already out in market raising for the next fund. And what needs to happen between year 5 through 7 is you need to see that portfolio that you've invested in hit the model that you require, which is, again, for emerging fund managers, you have a best case, you have a kind of okay case, and then you have a zombie case. And, I'm not trying to create a context for us for what we're going to talk about in terms of the upcoming service, that why what we're talking about is so much needed. It's actually, ironically, the market has actually just shifted, I think, in boardroom Bullpen's favor. But what we're seeing is over the last 5 years is we've seen individuals, institutions, LPs, their portfolios are in the zombie case right now. So the pressure is on, if you're an emerging fund manager, to have the capabilities to provide the reporting structures, provide the potentially operating partners to help increase the probability that your companies are going to be successful. Bit of a long breakdown, but hopefully there's a lot of context. I think a lot of meat that we can pull out. And Ted, I saw you trying to get in there, trying to get JC to stop talking. So I'll over to you, Ted.
You went deep, and I absolutely appreciate that. I guess from a summary standpoint, Jason, I just want to confirm, because you went deep on both of these, but I just want to confirm, there's 2 things that you're really looking at that you're spending the majority of your time on. That's looking at investments and getting investors. Is it fair to say it's as simple as that, as to what your focus is, not to where you're spending the majority of your time right now? Because that could be in a bunch of different directions, given that you have a small team right now. So confirming that, and then what should you be doing that you don't have time to do, or that ultimately, as a fund manager, you need help with?
Yeah, the hardest part about the allocation of time and the concern that keeps an emerging fund manager up at night is once you have deployed that capital, and we have deployed some capital this year, as you know, what is our reporting structure look like? How do we keep a strong cadence of communication with that founder? How do we not impress upon them our thoughts on how they should run their business, but provide them with the opportunity to communicate to us that they need help? And that requires an authentic, custom built level of operations for them that again, we've pitched this because we were an operator first fund. Anybody that's touching this fund has some significant experience in the category that we're dealing with. But that, Ted, keeps me up at night is, do we have the right people that can help these folks do what they want to do? And again, just for the audience's sake, the folks that we're investing in are scientists, engineers. They're not necessarily trained at accounting, marketing, PR, business development, sales. And what can happen as an investor is you can look at this person and go, okay, hits checklist, opportunity, love it, team, love it, product in market, making money. But as an investor, we always ask, how can you make me more money? And you're always asking that, as operators, this, being in that world, that people are always saying, coming back to you saying, hey, make me more, make me more money. What is the next level that you want to hit? And so in summary, what can I do better? How can I provide more value to those founders at the right time so they can take advantage of the problem they have and then create a world-class solution for it so they can get to that next level sooner than later? Because if they don't, things just start to spin out of control, and then it becomes a whole nother problem around governance and risk and so forth.
So if you don't mind, Ted, I think this would be I know we didn't talk about this when we did our preparation for today, but I think one thing that's really interesting, so we have Jason here who is going out and looking for investors in his fund and then going to go make investments. So Ted has, 20 plus years of experience doing fundraising, seeking folks like Jason to make investments in companies that he's worked for. He's had successful exits in the past as well. He's raised, let's just say, a lot of money during his career.
Quarter of a billion, I think.
Right. And so, I think
shy away from friends, not to shy away.
So I think it would be interesting just maybe for a minute, Ted, just again to kind of juxtapose this more, because I think it also sets up the conversation for why we've created this solution at Boardroom, Operating Partner as a Service, OPAAS. And we can talk about it, but it fits up, I think, kind of both of these dimensions. So Jason, thanks for kind of setting this up a little bit. But Ted, if you could maybe talk a little bit about what have you seen in the past? Like what is the investor looking for? Not on the front end, like to make the investment, but then also kind of what are they expecting like quickly thereafter?
So all investors are different, obviously, but in the VC space, from an investment standpoint, you can get from all of the different VCs, what is their focus? What metrics are they looking for a potential company to hit? I've been asked hundreds of times, if you look at my network on LinkedIn, investors X, Y, and Z, which, yes, I know investors X, Y, and Z. I also know what they invest in, and I know what the KPIs they're looking to hit are. And so it's always one of those difficult conversations to have with a founder where, yes, I know this firm, but you're not ready for this firm. You're not ready to talk to this firm. You're not big enough. You don't have the right team in place yet at this point in time. Your ARR is not high enough. Your churn's too high. I mean, there's a multitude of things that venture capitalists are going to look at when they're thinking about an investment. And so, I won't name specific VCs at this point in time, but they all do have what they're looking for. And you can try and pitch them. You may even get into the room, but if it doesn't fit their investment thesis, and I think Jason can talk to this because I'm sure he wouldn't want me bringing a B2C consumer app to him, it just wouldn't make sense. And so they're looking for a specific company, a specific industry, specific metrics that are going to fit. And I think the last part of the question that you asked, Clint, was, what are they looking for? What are they looking for from a return to their investors? And so a general rule of thumb is next their investment, which seems steep, but Jason mentioned early on that they're going to invest in 10 companies. You went through, zombie and then what I'd call unicorn at the top end of it. And that's what ultimately balances out to get investors the return they're looking for and why they're investing in VC funds in the first place. And so I just, Jason, if you want to validate or talk a little bit about, here's the criteria. If you can't talk about the criteria more generally, this is what we're looking for. I think that would be helpful as well.
Yeah, and one thing I'd like to do too, just because of the time we've got kind of in the show today, is kind of wrap this back to what we're hearing, like specifically in the private equity space, because I think sometimes people think that they're like fundamentally different, and they're more of the same than they are different. So here's the things that I've heard kind of from Ted and Jason today that I think are really kind of important to talk about. What we're seeing on the emerging private equity side as well is very similar situation where there is this significant stress of going out and trying to find investors who are interested in making a substantial investment, who buy into your investment thesis. There's a lot of work and energy that goes into that. On the other hand, there's then the pressure to say, okay, now I've given you some money. I need to get return on my money as fast as possible, which means you have to go get companies that you're going to make an investment in. And then those companies have to have some success, right? And so private equity space, we're seeing exactly the same thing, especially like in the smaller cases where, like in Jason's case, he's doing a lot of this stuff on his own. We see a lot of times kind of 2-person teams out there. So one's focused on getting the investors, the other one's going out and beating the street trying to find the investments. But there's all these other things in the middle, which Jason kind of talked about earlier, and Ted touched on as well in terms of what the investor's expecting, which is like infrastructure, discipline, process, which all leads to returns. And so what in the past has happened in these spaces is there's been a lot of energy in kind of what I'll call the old guard, which we're trying to kind of reposition into the new guard, which is let me go out and get a bunch of people that I've worked with or that in this space. We're going to kind of build this team out. In the private equity vernacular, that's going to be an operating partner. And there's usually a heavy lift in terms of like assembling this group. There's a heavy lift in terms of short-term and long-term investment in this group, which means there's a lot of burden for everyone involved to even get greater returns in order to get the ROI that they need in these investments that are made. So basically they put a ton of incremental pressure on themselves, like right out of the gates, which is going to make it even more difficult to get the types of returns everybody who is invested, either through blood, sweat, and tears that Jason's putting in, trying to put it together, or the people who actually put their cash into play. And so that is why we really believe in what we're doing on Operating Partners as Service, which is kind of turning the whole thing on its ear. And if you want to use like a manufacturing term, it's just in time. And it's really about saying what is needed and when is it needed and delivering it just as in time and making little to no investment beforehand. And so what we really believe, and we're getting some really great traction in the market around this, is building an infrastructure that says, listen, you focus on going and getting the investors, you focus on getting the investments, and let us kind of take care of everything in the center. Let us take all that other burden off of you. And oh, by the way, don't make a massive investment in that. So everybody can move faster and we can get better ROI out of the entire engagement. And so what that means for us is everything from, do you need support in terms of the due diligence, FP&A analysis that you're doing on these potential companies that are coming in? Do you need Johnny on the spot field audit support for the organization? Do you need to build an infrastructure for finance and accounting practices? So can you bring in a fractional CFO into your organization who's going to build accounting and bookkeeping principles, so as you're acquiring companies, you're not spending tons of time 2 years from now continuing to band-aid things together, because that's not what those companies that you acquire were good at the beginning, right? And then generally there is, at the point of investment, there's usually a vacancy or gap in terms of the specific role in the organization that's needed to move the business forward. If they were doing great on their own, they probably don't need an investor. So they need that catapult. So that could be a fractional, an interim, or a full-time executive in a specific spot. And then what oftentimes happens when there's an investment, there's somebody who says, this isn't for me. There's somebody in the legacy business who says, this is going in a slightly different direction in terms of where I wanted to be. I'm out, right? And so all of a sudden there's this gaping hole. And so what we're saying is, let us take all that pressure. We provide strategic advisor support services for you to kind of help you stand up shared services, help you make sure you have a good roadmap for the operating cadence for the acquisitions that you're making. And then we'll just go build and scale out those processes or shared services solutions for you as they make sense and not beforehand. And so we just really believe that to all the things that you shared in terms of like background and experience of what you're on the ground seeing, Jason, right from the mouth of somebody who's doing it, what we're hearing, Ted and I out on the street talking to folks, both in the VC and the private equity and kind of independent sponsor space, family offices as well, are kind of dealing with some of these challenges as well. And we really believe that we're kind of turning this on its ear and doing it differently, which I think just changes the game substantially in terms of allowing everyone to move faster and to get a better ROI, not only in the short term, but in the long run as well. So, I mean, it'd be great, Jason. I mean, just we've obviously talked about this a lot over the last several months as we've started to kind of build out our thesis around this. But it'd be awesome just in terms of kind of some of the time we have left, from your perspective, how does that help someone like you, both on VC or private equity space? How does that allow you to provide better value to the investors and better value to those who you're investing in?
Well, what we know is clear is that whether you're an emerging fund manager or setting up a new PE shop, there's no excuse for being immature operationally. So it's clear LPs require institutional infrastructure, proven judgment, compelling differentiation, scalable processes. So in the lifetime of building a fund, LPs are expecting some level of operational difference. The thought process here today is that operations as a service is 100% a model that funds and deal sponsors can instantly acquire that firepower for, and can build their business models around that, enabling the value-added capabilities that they marketed when they were raising their fund to become tangible, right? So how can we provide tangible ways for our portfolio companies post-investment? How do we provide them with operator expertise, the talent network, the strategic partnerships, and so forth? World-class execution is everything. And I think in today's podcast, this introduction of operations as a service is something that any listener here, anybody that's building a fund, anybody that's building a new PE shop should take advantage of, essentially.
Yeah, an operating partner as a service for us is not just an idea. I mean, it's something that we're talking actively in the market. One of our kind of newest relationships in this space, brand new private equity fund, very close to kind of deploying capital for the first time here as we wrap up the third quarter. They're enthusiastic about this from a couple perspectives. I mean, kind of right from the mouth of the person who's doing the pitches, both to investors and going out and actively seeking companies that they're going to invest in, is we want this on our investor deck because it helps position us in a way about how thoughtful we are being about how we're going to support the growth of these organizations and do it in a really financially responsible way. And for the companies that they're investing in who are really seeking investment and support because there's things that they recognize that they can't do on their own to elevate the business, it creates a differentiating factor for them versus maybe other people that are coming to the table who are interested in acquiring their company or making an investment in the company. So it's a two-sided coin. It's that is really, really powerful. An operating partner as a service. And I always want to make sure that we use kind of not just the operations as a service, but operating partner, because what that has fundamentally meant in the past is everything that goes into executing an organization successfully. So that spans beyond operations. It spans marketing, sales, the financial structure of an organization, technology infrastructure and support and development. It's all of those things, right? And that's where operating partners have generally spanned all of those disciplines. And we're creating a mechanism to do all of those things, right? But only when needed, and at the right level of engagement at the right time and not before.
And I think to synthesize what Clint said, it's really about efficiency. Why would anybody put a firm like Boardroom Bullpen on their deck? Because there has been a focus. I mean, the focus isn't just PEs and VCs that are making the investments. that are looking at efficiency, it's the investors themselves. And so if you can bring a better mousetrap, if you can, as opposed to bringing on multiple operating partners, if you can use an outside service to do it from a cost standpoint, from an efficiency standpoint, it's something that resonates with investors and funds.
Yeah, and I'll just add as well as we close out this episode that while efficiency is paramount because it increases probability of execution and then ultimately outcome, from my perspective, for someone that's building this, I don't have to do this. And what I mean by that is I've made a conscious decision to go and build a fund. And I've done that because I have as we like to say, Clint and Ted, vivid vision of what I want to do and see happen. And a part of that vivid vision is working with world-class people. And we've always talked about this since the development and the creation of Boardroom Bullpen. The differentiator for Boardroom Bullpen is access to truly world-class professionals. These are individuals that actually have sat at the C-level, VP, director level title. And one of the biggest problems that any of us that are building anything face is access to talent at this point. This is the biggest gap in our economy currently right now. How do we vet talent? How do we get access to it? How do we do that yesterday, essentially? So I'd like to, state that a part of a decision-making of being able to get access to operators of service, I think, or for our listeners, is to also realize that these operators are, in fact, people that you would enjoy working with, right? You'd enjoy doing business with. Because I don't want to cloud the fact that ROI is always, front and center. We have to enjoy the journey. And that's really something that's come up in my journey to make sure I've made specific business decisions to not have specific LPs, to not work with certain people. And I think that's really important in anybody's journey. And that, I believe we all three have agreed, is an important component of anyone that we're working with in terms of vetting process. So in summary, we'll be looking to announce a relationship. Humanist will be looking to announce a relationship with Boardroom Bullpen in the coming weeks. But we are making that decision because we genuinely enjoy working with Boardroom Bullpen. We know the network is strong, deep, and we know that the expertise increases the probability of success when we do engage with Boardroom Bullpen. So, gentlemen, that's a wonderful testimony that I think, hopefully speaks volumes to the authenticity of what Boardroom Bullpen offers.
We obviously appreciate that, Jason. Thank you so much.
Yeah, indeed. Jason, thanks for sharing kind of your vulnerability today on kind of the journey that you're going through. I think it's important. We talk about vulnerability a lot, and we also recognize if we're directly working with a startup, if we're directly working with a local family enterprise business, or we're working with emerging investors, part of our ability to be helpful is for those to recognize that they need help, that they want help, that they want to seek the right kind of help. And when people are ready for that, we believe that we can be the solution to cure their ills. So appreciate your perspective around that. Appreciate us getting the opportunity to kind of unpack the market tension that's out there today, how we can solve that market tension, how we've been thoughtful about how we're going to do it, how you as an investor are interested in buying into what we're selling, which we do believe has a huge value proposition, and super helpful for the time that Ted shared about his 20 years of experience kind of on the fundraising side of it as well. I think super, super helpful. We're excited about operating partners as a service. We really believe it's a great fit for PEs, VCs, family offices, and even the independent sponsor space that's kind of early in their journey, where we can relieve a lot of pressure and tension going forward.
If you're a GP, a VC, or a deal sponsor, and you want to be the first to explore operating partner as a service, go to boardroombullpen.com or reach out to Ted and Clint on LinkedIn. With that, I'm Jason Carvalho.
And I'm Clint Overton.
And I'm Ted Stann.
If you found today's discussion valuable, hit subscribe, like, and share with your colleagues. We'll see you next time.